Global markets are reacting sharply as the United States, Israel, and Iran conflict escalates, pushing up energy prices, spiking risk aversion, and rattling equities from Asia to Africa. At the center of the market panic is the Strait of Hormuz, the narrow waterway linking the Gulf to the Arabian Sea. Roughly one-fifth of global oil supply moves through this route every day, alongside major volumes of liquefied natural gas and refined fuels. While the strait has not been officially sealed shut, shipping activity has effectively slowed as tankers hesitate to enter. War risk insurance costs rise and safety concerns spread after US and Israeli strikes on Iran and Tehran's retaliatory attacks across the region. That uncertainty is now hitting the plumbing of oil pricing itself. S&P Global Platts, one of the world's most influential oil price reporting agencies, has suspended bids and offers for its Middle East refined products assessments where deliveries require transit through the Strait of Hormuz. Platts is also reviewing how deliverable Middle East crude remains from Gulf ports, a rare move that underscores how disrupted trade routes can distort benchmark prices. Oil markets responded immediately. Brent crude jumped 6.4% to around $77.57 a barrel early Monday, after briefly topping $82, while US crude rose more than 6% to just over $71 a barrel. Gold climbed as investors rushed to safety, rising 1.6% to around $5,360 an ounce. The concern is straightforward. If supply risks persist, oil could move toward $100 a barrel, reviving inflation globally and squeezing economies already struggling with high import bills. And Pakistan has felt that shock in real time. Pakistan's benchmark KSE 100 index crashed more than 15,000 points shortly after the market opened on Monday, triggering a temporary trading halt. When trading resumed around 10:30 a.m., the index was down 12,334.88 points from its previous close of 168,062.16, a fall of 7.34%. By 11:07 a.m., losses narrowed slightly, with the index down 9,164.62 points, still a steep decline of 5.45%. The sell-off reflects the immediate fear in oil importing economies. Higher crude means higher inflation, heavier pressure on foreign exchange, and greater stress on external financing. Across the rest of Asia, emerging market stocks and currencies also slid as investors moved into safe havens such as the US dollar, gold, and sovereign debt. Countries heavily dependent on imported fuel, including India, Thailand, and the Philippines, saw currencies weaken, while regional equities fell sharply, with airlines and travel-linked stocks among the biggest losses due to higher fuel costs and potential flight disruptions. Japan's Nikkei index declined while broader Asia-Pacific markets slid as investors moved money into traditional safe havens such as gold, US Treasury bonds, and the dollar. India's central bank was reported to have stepped in to smooth volatility in the rupee as oil prices climbed, underlining how quickly an energy shock becomes a currency and inflation story. With markets now pricing in longer conflict risk, investors are reassessing the path of interest rates globally, especially in the United States, where a heavy data week could shift expectations around Federal Reserve rate cuts. The sell-off wasn't limited to Asia. European and US stock futures also turned lower as investors priced in the risk of higher inflation and weaker growth. Bond markets initially saw demand for US Treasuries as a haven before yields steadied again as traders weather an oil-driven inflation shock could keep rates higher for longer. In the Gulf itself, the turmoil also forced market interruptions. Kuwait Stock Exchange suspended trading while the UAE halted trading in Abu Dhabi and Dubai for a short period, citing exceptional circumstances linked to the regional situation, and the impact is reaching Africa as well. In South Africa, investors began the week watching the same global risk-off wave, oil prices higher, equities under pressure internationally, and gold stronger. Locally, attention is also on key economic and corporate signals, including February vehicle sales, a treasury bill auction, foreign investor flows into South African bonds and equities, and major company updates like Woolworth's half-year results. In Johannesburg, resource-linked counters can benefit from commodity strength, and local reporting notes energy exposure, in particular with Sasol among the names in focus as the oil spike reshapes sentiment. Taken together, the market message is clear the conflict premium is now being priced across oil, shipping, currencies, stocks, and inflation expectations. For emerging economies across Asia and Africa, the immediate vulnerability is the same. If oil stays elevated and shipping through Hormuz remains disrupted, the pain spreads quickly from higher import bills to weaker currencies, inflation pressure, and heavy volatility in equity markets. And until there is clarity on whether this conflict de-escalates, investors globally will keep doing one thing: watching tankers, watching oil, and bracing for the next shock.